Most people think markets move because of earnings. Some think they move because of inflation. Others think they move because of interest rates, politics, wars, oil, headlines, or hype. But beneath all of that, there is a deeper force. A force that decides whether risk rises or dies. A force that determines whether stocks climb, whether crypto explodes, whether credit expands, whether real estate levitates, and whether panic spreads like fire through the financial system. That force is liquidity. And if you do not understand liquidity, you do not understand markets. Because liquidity is not just another variable. Liquidity is the operating environment. It is the invisible plumbing behind every asset boom and every financial accident. It is the hidden current under the surface of price. And the reason most people miss it is simple. Liquidity does not scream. It flows, quietly, underneath, until suddenly it is everywhere, or nowhere. And when it disappears, everything changes. In this video, we are going to break liquidity down from the ground up. Not with surface-level definitions, not with recycled textbook language, not with the usual nonsense about more money equals markets up. We are going deeper. We are going to talk about what liquidity actually is, where it comes from, who creates it, how it expands, how it contracts, why markets become addicted to it, why central banks are trapped by it, why debt systems cannot survive without it, why crashes are almost always liquidity events first and narrative events second, and why the people who really understand liquidity see market shifts before the headlines do. Because once you understand liquidity, the market stops looking random and starts looking structural. So let's start where we have to start, with the question almost everyone gets wrong: what is liquidity? Liquidity is usually explained in one of two shallow ways. The first is that liquidity means cash. The second is that liquidity means how easily something can be bought or sold. Both are incomplete. Cash is part of liquidity. Market depth is part of liquidity. But liquidity is bigger than both. Liquidity is the capacity of the financial system to fund activity, absorb transactions, support leverage, and keep asset prices functioning without disorder. That is the real idea. Liquidity is not just money sitting somewhere. It is usable financial energy. It is spendable balance sheet. It is the system's ability to finance risk. It is what allows institutions to borrow, lend, roll debt, post collateral, mark assets, make markets, and maintain confidence. When liquidity is abundant, the system can tolerate risk. When liquidity is scarce, the system starts choking. This is why a market can look strong one week and fragile the next. The surface might not change much, but underneath, liquidity conditions can shift dramatically. And those shifts matter more than most investors realize. Because markets are not just valuation machines, they are liquidity machines. An asset can stay expensive when liquidity is loose. An asset can collapse while still looking cheap when liquidity is tight. That is one of the most important truths in all of macro. Price does not only reflect value, price also reflects liquidity. In fact, during many phases of the cycle, liquidity dominates value, and once you see that, a lot of strange market behavior stops being strange. You stop asking why overvalued assets keep rising. You stop being shocked that good companies get destroyed in downturns. You stop assuming fundamentals are enough, because you begin to understand that the system first asks, is there funding? Is there collateral? Is there market depth? Is there appetite? Is there balance sheet capacity? Can risk still be financed? That is liquidity. Liquidity is the difference between a functioning market and a disorderly one. Liquidity is the difference between easy refinancing and systemic stress. Liquidity is the difference between a correction and a cascade. And if you want to know where markets go next, you have to know what liquidity is doing now. So where does liquidity come from? To answer that, we have to move from definition to mechanics. There are many channels through which liquidity enters the system, but the big ones can be organized into four primary sources: central bank liquidity, bank credit creation, government deficit spending and treasury flows, and private market collateral and leverage. Let's take them one at a time. Central bank liquidity. This is the part most people focus on. The central bank can inject or withdraw liquidity through policy rates, asset purchases, lending facilities, reserve management, repo operations, and communication that affects financial conditions. When the central bank cuts rates, expands its balance sheet, or backstops funding markets, it is supporting liquidity. When it hikes aggressively, runs quantitative tightening, or allows collateral stress to spread, it is draining or tightening liquidity conditions. But central banks are not the only source. And this is where people oversimplify. Bank credit creation. Commercial banks create liquidity every time they expand credit. This point is crucial. In modern monetary systems, much of what functions as money is created through lending. When banks make loans, they create deposits. That expands purchasing power and financial activity. Credit creation is liquidity creation. When banks are confident, capital is available, regulation is manageable, and losses are low, credit expands. When they are defensive, worried about defaults, constrained by capital requirements, or facing funding stress, credit tightens. And when credit tightens, liquidity falls, even if policy headlines sound supportive. Government deficit flows. Governments also affect liquidity in powerful ways. When governments spend more than they tax, deficits inject net financial assets into the private sector. The details matter, especially in treasury funding and reserve settlement. But the broad point is this: fiscal deficits can support aggregate liquidity. This is one reason markets can remain more resilient than expected during certain slowdown phases. People underestimate the power of fiscal liquidity. Private collateral and leverage. Then there is market-generated liquidity. Collateral chains, repo funding, dealer balance sheets, hedge fund leverage, private credit, margin systems, and structured finance all create effective liquidity inside the system. This is where things become highly reflexive. When asset prices rise, collateral values rise. When collateral values rise, borrowing capacity rises. When borrowing capacity rises, more risk can be financed. That supports more buying, that supports higher prices, that supports more collateral. That is how liquidity and asset prices feed each other until they stop. Then the process reverses, collateral falls, borrowing shrinks, margin calls hit, selling increases, liquidity vanishes, and what looked stable becomes unstable very quickly. This is why booms feel self-reinforcing, because they are. And this is why crashes often feel sudden, because the liquidity supporting them was more fragile than it appeared. So now we know liquidity is not one thing. It is a network of support mechanisms, some official, some private, some visible, some hidden. The next question is the one that matters most to investors. How exactly does liquidity push markets higher? When liquidity expands, it does not hit every asset equally or instantly, but over time, it changes the behavior of the entire financial system. Here is what happens. First, funding becomes easier. Borrowing costs stabilize or fall. Refinancing risk drops. Credit spreads tighten. Balance sheets become easier to manage. Dealers feel more comfortable making markets. Investors feel more comfortable taking risk. Then, as the perception of stability increases, capital starts reaching further out on the risk curve. Cash becomes less attractive. Short-duration safety feels less necessary. Investors begin reallocating from cash to bonds, from bonds to equities, from large caps to growth, from growth to speculative tech, from speculative tech to crypto, from public markets to private markets, from safety to duration, from duration to narrative. This is how liquidity works in practice. It lowers the perceived cost of risk. And once that happens, valuation discipline begins to weaken. That is not because investors suddenly become stupid. It is because liquidity changes the incentives. When funding is abundant and downside is buffered, the system becomes more tolerant of stretched multiples, weak cash flows, and longer duration bets. That is why liquidity-rich environments produce strange behavior. Things that shouldn't work keep working. Things that look disconnected from reality go vertical. Things with no immediate earnings or weak fundamentals become stars. Because in liquidity-driven phases, future optionality becomes more valuable than current discipline. This is one reason tech and crypto often respond so violently to liquidity shifts. They are highly duration-sensitive, narrative-rich, and leverage-compatible. In plain language, they thrive when the system is flooded and suffer when the system dries out. But liquidity affects more than just asset prices. It affects confidence, and confidence is a transmission mechanism all by itself. When prices rise, people feel wealthier. When collateral rises, balance sheets look healthier. When financing stays easy, defaults stay contained. When defaults stay contained, lenders stay open. When lenders stay open, liquidity remains available. Again, this is reflexive. Liquidity supports price, price supports confidence, confidence supports lending, lending supports liquidity. It becomes a loop. That is why a bull market can feel unstoppable, because inside the loop, every component is reinforcing the others. But the reverse is also true. When liquidity tightens, this entire chain begins to break. And that takes us to the darker side of the story. Almost every financial crisis looks different on the surface, but under the surface they usually rhyme. There is some form of tightening, some form of funding stress, some form of collateral pressure, some form of balance sheet constraint, some form of forced selling. That is a liquidity problem. The headlines always make it sound like the crisis is about one specific thing: subprime mortgages, a hedge fund, a bank failure, a sovereign debt issue, a currency mismatch, a policy mistake. And those details matter. But what turns a problem into a crisis is usually liquidity. Because systems can survive bad news when liquidity is strong. They struggle to survive ordinary stress when liquidity is weak. That is the difference. When liquidity disappears, markets stop functioning smoothly. Bid-ask spreads widen, dealers step back, funding costs jump, collateral gets repriced, margin calls spread, rolling debt becomes harder, weak hands become forced sellers, strong hands become cautious. Everyone starts valuing cash more than return. That shift in preference is fatal for speculative assets, because when liquidity is scarce, the market stops rewarding possibility and starts rewarding survival. Suddenly the question is no longer, what could this asset become? It becomes, can this position survive funding stress? That is a completely different environment. And this is why tightening cycles are so dangerous. Not because higher rates are inherently catastrophic, but because higher rates interact with debt, leverage, collateral, and refinancing needs. The system is layered with obligations. When the cost of rolling those obligations rises, fragility rises too. And once fragility rises enough, liquidity gets pulled inward. Institutions become more defensive. Banks lend less. Investors de-risk. Market makers reduce size. Liquidity gets more selective, then one break appears, then another. Then what looked isolated becomes systemic. This is how liquidity crises spread. They spread through balance sheets, they spread through trust, they spread through collateral, they spread through the realization that what seemed liquid was only liquid under good conditions. And that is a brutal realization, because many assets are not truly liquid. They are conditionally liquid. They are liquid as long as confidence holds, buyers remain, funding works, and no one has to exit all at once. But in real stress, true liquidity gets exposed, and that is when markets gap. That is when correlations go to one. That is when diversification fails. That is when investors realize they were not holding independent risks. They were holding the same liquidity exposure in different wrappers. Once you understand that, you stop looking at crises as random accidents. You begin to see them as liquidity events waiting for a narrative. Now let's go deeper, Because if liquidity is so central, who really controls it? No single actor controls all liquidity. That is the first thing to understand. The system is too large, too layered, and too global for that. But some institutions influence liquidity far more than others. The central bank is the most obvious. It sets the policy rate. It influences reserve conditions. It can lend against collateral. It can buy assets. It can intervene when markets seize. It can shape financial conditions through signaling alone. That makes it massively important. But central banks are not omnipotent. They influence the price of liquidity and the emergency backstop for liquidity. They do not control every private flow. They do not directly force banks to lend. They do not control global demand for collateral. They do not eliminate solvency problems. And they cannot permanently override structural imbalances without consequences. Then there are commercial banks. Banks matter because they create credit and intermediate payment and funding channels throughout the economy. If banks pull back, liquidity contracts. If banks expand, liquidity rises. But banks themselves are constrained by capital rules, regulation, profitability, deposit stability, and perceived risk. Then there are governments and treasuries. Fiscal authorities affect liquidity through deficits, issuance, spending, tax collection, guarantees, and responses to crises. Sometimes fiscal policy can overwhelm monetary tightening in practice. This is one reason macro is so difficult. One arm may be tightening while another is injecting. You have to follow the combined effect. Then there are large institutional actors, dealers, primary dealers, money market funds, hedge funds, pension funds, sovereign wealth funds, private credit managers, global reserve holders. These players affect how liquidity moves through markets, what gets financed, what gets sold, and how collateral chains behave. Then there is the international dimension. Dollar liquidity is not just a domestic issue. The dollar is global funding infrastructure. That means offshore dollar demand, swap lines, reserve systems, trade finance, and foreign balance sheets all matter. A shortage of dollar liquidity abroad can spill back into domestic markets very quickly. That is one reason the system is so complex. Liquidity is local in some channels and global in others, and because of that, central banks are often reactive. They influence liquidity, but they also respond to it. They do not operate outside the system. They operate inside a debt-based, leverage-sensitive, politically constrained environment, which means they are often trapped. And once you understand that, you begin to see why central banks say one thing, do another, and then explain it later. Because liquidity can force their hand. That brings us to one of the most misunderstood ideas in macro: why debt systems require liquidity expansion. Modern financial systems are not built around hard settlement and static money. They are built around rolling obligations. Debt is continuously issued, refinanced, repriced, pledged, and extended. That means the system does not just need money, it needs flow, it needs rollover capacity, it needs enough liquidity to maintain the chain of obligations. This is why the phrase "paying off all the debt" is structurally misleading. The system is not designed for debt extinction. It is designed for debt circulation. Debt matures. New debt replaces old debt. Refinancing maintains continuity. Collateral supports funding. Funding supports risk assets. Risk assets support collateral values. And around it goes. If debt growth slows too much, nominal growth slows. If nominal growth slows while obligations remain, pressure builds. If pressure builds, defaults rise, or policy support increases. That is the structural trap. The system requires enough liquidity to keep debt service manageable and refinancing functioning. This is why policymakers fear disorderly tightening more than they admit, because they know the system is highly debt-dependent. And that dependency means liquidity is not optional. It is foundational. This does not mean every debt increase is bullish forever. It means the system has a built-in bias towards support, accommodation, and intervention whenever tightening threatens systemic function. That bias may be delayed, it may be political, it may arrive only after pain, but it exists. And once investors understand that bias, they begin to front-run it. They begin to look for the pivot. They begin to watch liquidity more than rhetoric. They begin to realize that the true question is not whether authorities want moral purity. It is whether they can tolerate disorder. Usually they cannot. This is one reason markets are often more forward-looking than policy statements. Markets know that when enough stress builds, liquidity will become the answer. Maybe not immediately, maybe not cleanly, maybe not without damage, but eventually. And that expectation changes behavior across the system. That expectation itself becomes part of the market structure. It encourages risk-taking in good times. It creates fragility in excess. Then it punishes that fragility when tightening arrives. Then it pulls policy back toward support. Then the cycle begins again. This is not just economics, this is architecture, a liquidity-dependent debt architecture. And it explains why so many cycles feel repetitive. Different story, same plumbing. Now let's connect liquidity to rates, because this is where many people get confused. People often talk as if rates and liquidity are the same thing. They are related, but not identical. Interest rates are the price of short-term money set by policy, and more broadly, the price of funding across maturities. Liquidity is the availability and functioning of funding, collateral, and balance sheet support across the system. Rates affect liquidity, but rates do not fully define liquidity. This distinction matters. A high-rate environment can still have pockets of strong liquidity if fiscal flows are large, credit channels remain open, and market participants are comfortable extending risk. A low-rate environment can still suffer liquidity stress if collateral breaks, leverage unwinds, or trust collapses. The relationship is dynamic. Lower rates generally support liquidity by reducing funding strain and increasing tolerance for duration and leverage. Higher rates generally tighten liquidity by increasing debt service burdens, repricing assets lower, and reducing rollover ease. But the actual effect depends on the whole system. What is fiscal doing? What is bank lending doing? What is treasury issuance doing? What are credit spreads doing? What is happening in repo? What are reserve levels doing? What is the dollar doing? This is why macro cannot be reduced to one variable. And this is why people get trapped in bad takes. They think one cut means risk on forever, or one hike means collapse immediately. Reality is more layered. Sometimes markets rally during hikes because liquidity from other channels offsets the tightening. Sometimes markets fall during cuts because cuts arrive in response to severe deterioration. Context matters, sequence matters, system structure matters. Liquidity is the bridge that connects rates to actual market outcomes. And the best macro operators know this. They do not just ask, well, what did the central bank do? They ask, well, what did that do to liquidity conditions across the system? That is a much better question, because market behavior depends less on the headline and more on the transmission. Now let's talk about how investors can actually monitor liquidity in the real world. Liquidity is invisible in the sense that no single screen shows you total liquidity truth. But there are signals, and if you learn to read them together, you can develop a much sharper feel for the environment. First, watch policy direction and balance sheet behavior. Is the central bank expanding or shrinking support? Are emergency facilities opening? Are reserves being added or drained? Second, watch credit spreads. When spreads tighten, risk is easier to finance. When spreads widen sharply, the market is signaling stress in funding and credit conditions. Third, watch the yield curve and real rates. They affect duration sensitivity, refinancing conditions, and asset tolerance. Fourth, watch bank lending standards and credit availability. When lending standards tighten, liquidity is usually becoming more selective. Fifth, watch repo markets and collateral stress indicators. These are plumbing level signals. Most retail participants ignore them. They should not. Sixth, watch the dollar. A sharply rising dollar can tighten global liquidity significantly, especially in highly dollarized or dollar-funded parts of the world. Seventh, watch market breadth and leadership. When only a narrow set of assets can rise while the rest of the market weakens, liquidity may be becoming more concentrated and fragile. Eighth, watch volatility. Not because volatility alone defines liquidity, but because disorderly volatility often reflects deteriorating market depth and confidence. Ninth, watch fiscal flows and treasury issuance dynamics. Liquidity conditions can change depending on where cash is being parked, how issuance is being absorbed, and how government flows interact with reserves. 10th, watch behavior in the weakest parts of the system. Small banks, commercial real estate, leveraged loans, high yield, private credit stress, regional funding stress. These areas often show liquidity fractures before the broad market reacts. And most importantly, do not isolate one signal. Watch the cluster. Liquidity is a mosaic. What you want is a sense of whether funding is getting easier or harder, whether balance sheets are expanding or contracting, whether risk is becoming more or less financeable. That is the real read. And once you build that habit, you begin to see market turning points sooner. Not perfectly, but earlier. Now let's deal with one of the biggest myths in finance, the idea that fundamentals alone drive long-term price. Fundamentals matter. Over long horizons, they matter a lot. Cash flows, productivity, margins, innovation, balance sheet quality, competitiveness, valuation, all of that matters. But there are huge stretches of time where liquidity dominates the path. And if you ignore that, you misread the market. An asset can have strong fundamentals and still collapse in a liquidity squeeze. An asset can have weak fundamentals and still soar in a liquidity wave. That is not irrational. That is structural. Because markets are not clean, discounting machines operating in a vacuum. They are financing ecosystems. Everything inside them is influenced by who can borrow, who can roll positions, who has balance sheet, who can absorb supply, and who is forced to sell. Those are liquidity questions. That is why timing matters so much. A good asset in a bad liquidity regime can perform terribly. A bad asset in a flood of liquidity can perform shockingly well. That does not mean value is fake. It means liquidity determines whether value can express itself. This is especially true in turning points. Late in the cycle, people cling to valuation arguments while liquidity deteriorates. Early in the news cycle, people cling to fear while liquidity improves. In both cases, they miss the transition. The market is moving on liquidity before the narrative catches up. That is why understanding liquidity is such an edge. It helps you separate the story from the structure. Now let's go deeper into one of the most powerful parts of the liquidity story: reflexivity. Liquidity is not linear, it is reflexive. That means it affects prices, and prices feed back into liquidity. This creates self-reinforcing loops. When prices rise, collateral values improve. When collateral values improve, leverage capacity improves. When leverage capacity improves, more buying becomes possible. When more buying happens, prices rise further. That is one loop. When confidence rises, investors become less defensive. They extend duration. They compress spreads. They buy lower quality assets. That makes funding feel safer. That encourages more issuance. That supports more activity. That is another loop. But when the cycle turns, the reflexivity goes into reverse. Prices fall, collateral weakens, leverage gets cut, funding gets tighter, selling increases, confidence drops, market depth deteriorates, then prices fall further. That reverse loop is what turns corrections into cascades. It is also why central banks intervene when they do. They are often trying to break the reflexive downside loop before it becomes systemic, not because they love asset prices in the abstract, but because collapsing liquidity can trigger broader economic damage very quickly. This is one reason markets react so strongly to small policy changes at fragile moments. Because in a reflexive system, small changes in support can produce large changes in behavior. Once you understand that, you stop treating markets like static charts and begin treating them like adaptive systems, which is what they are. And adaptive systems are governed by flows, especially liquidity flows. Now let's bring this home. What does all of this mean for investors trying to survive and compound through cycles? A liquidity investor asks different questions, not just, is this a good company? Not just, is this asset cheap? Not just, what does the headline say? A liquidity investor asks, what environment is this asset living in? Is liquidity expanding or contracting? Who is being forced to buy? Who is being forced to sell? What is happening to collateral? What is happening to financing conditions? Who has balance sheet? Where is risk being subsidized? Where is risk being starved? What policy response becomes likely if stress deepens? That mindset changes everything. It does not guarantee perfect timing, nothing does. But it dramatically improves your situational awareness. It helps you avoid value traps during tightening. It helps you recognize opportunity during easing. It helps you understand why some rallies are real and some are just reflex squeezes. It helps you distinguish between durable support and temporary noise. And most importantly, it stops you from being surprised by things that are actually structural. The best investors are rarely shocked by the direction of the move. They are usually shocked only by the speed. Why? Because they were already watching liquidity. They already knew the environment was unstable, or supportive, or changing. That is the edge, not prediction in the mystical sense, structural understanding. And liquidity is one of the highest value structural lenses in all of markets. Now let's close with the deepest truth in this entire discussion. Liquidity is not the side story. It is the story beneath the story. It is the force beneath valuations, beneath narratives, beneath sentiment, beneath policy language. It is what makes risk possible. It is what turns fear into panic. It is what allows debt systems to function. It is what keeps asset booms alive longer than logic expects. It is what turns routine stress into systemic danger. It is what policymakers are really managing, whether they admit it directly or not. And it is what markets are constantly sensing, pricing, and reacting to beneath the surface. When liquidity is abundant, possibility expands. When liquidity contracts, reality gets enforced. That is the cycle. Again and again, different assets, different leaders, different headlines, same plumbing. So if you want to understand what comes next, stop looking only at the obvious. Stop watching only headlines. Stop assuming every move is about the story being told on financial television. Look underneath, watch the funding, watch the collateral, watch the balance sheets, watch the credit impulse, watch the policy transmission, watch the system's ability to absorb risk. Because liquidity is not glamorous. It is not usually the headline, but it is the thing that decides whether the headline matters. And once you truly understand that, you stop asking, why did markets do that? You start asking a better question. What was liquidity doing underneath? That question will take you further than most market commentary ever will. Because in the end, liquidity is not just part of the market. Liquidity is the condition that makes the market possible. And when that condition changes, everything else changes with it. Signal before noise. If this changed the way you think about markets, subscribe. Because this channel is built to decode the forces underneath price, policy, and panic. And if you want the next deep dive, the next logical topic is why debt can never really be repaid in a liquidity-based system. Most people think markets move because of earnings. Some think they move because of inflation. Others think they move because of interest rates, politics, wars, oil, headlines, or hype.